If you're trading the US30 all day, you're doing it all wrong. There's only one time in the day where the market actually moves, and it doesn't just move, it explodes. And that time is 15:30, the New York Open. If you miss this, you're missing out the biggest money-making opportunity of the day.
Welcome to RFT Airlines.
Now we're here in this PDF. In this PDF, we've got rules, like the game plan that you're going to follow before we take a trade. But one thing that I want you to notice about these rules here is that most of them, they are time-based. They are time-based, which is exactly what the market is. The market is based on time. The timing element plays a crucial role in trading as a whole. Not only with my trading model, but in trading as a whole. Because everything that we do it based on time. The market is open 24 hours, but that doesn't mean that all those 24 hours are tradable or safe to trade. There's a specific time that we're going to talk about here, which is the one that is safe to trade. These rules that I'm going to outline here, they are applicable on the NAS 100, USD, and BTC USD. So I don't want to see anyone applying these rules on the XAU USD, GBP USD, because the timing element for these are not the same, Now, let's start. Here we have 15:30 New York Open candle. So the New York Open candle is the one that take us in most of the time. Almost 70% of the time, we are getting tagged into a trade by a 15:30 New York Open candlestick. It is those few times whereby we are going to expect or wait for additional candlestick to paint out before the market reaches our entry place. But most of the time, we are getting tagged into the market or into a trade by the 15:30 New York Open. So that means no trade is taken before 15:30. All trades are taken on the other side of 15:30 right there. Now, secondly, we're going to talk about the impact of the midnight to 9. This one is so important because it tells us exactly if the market is going to be active at the right time or not. There are some times where you will find the trade, everything lines up perfectly, but when it is time for the market to move, it simply just consolidates, doesn't move, or simply just misbehaving, being choppy from there. It all lies here in the impact of the midnight to 9. Then we've got 9 and 15. 9 and 15, that is where we find the direction of the market that you're going to take at 15:30. If you're going to buy or sell. H4 candlestick, it is the one that have to agree with what we found here at 9 and 15. So that means H4 candlestick also falls under 9 and 15 there. You also check it almost in the same way, at the same time, to make sure that for time frame and 15-minute time frame here, they say the same thing. Then fifth one, we've got the average daily range right there, which is the one that is going to tell us exactly if we can still continue with the direction that it simply just found, or the market is done moving in the direction from there. Now the entries is between 15 and 16:30. Means on the other side of 16:30, if the market could get back to your entry place or entry point, we're not going to take a position from there because it is out of order. That means entry time is between 15:30 and 16:30. Now we're here on the real price chart for the USD. And this is the game plan that you're going to execute in this price chart right here. So this chart is going to be a rough sketch example that I'm going to show you. And then after that, when you understand everything, how to execute this game plan into the real price chart, then we'll move to the real price chart using a bar replay to give you the impression on how to approach the market that is moving from there. Now let's get into it and see what's going on. Okay, here firstly we have 15:30, the New York Open candle. What we want to see right here, we want to see the market open, either pick the high or pick the low. Now if the market open, pick the high, means you're going to sell, and if the market open, pick the low, means you're going to buy. But if you're going to use that logic alone, you're not going to be consistent. You will catch the profits there and there, but you won't be consistent. You need to use the logic plus direction of the market at hand. So how do we find the direction of the market in this case? This is where now we are going to introduce the 9 and 15. 9 to 15. So what are we looking at right here between 9 and 15? And what exactly are we looking to find that will give us the direction of the market that we want to take at the right time? We want to find two things. Either it's a continuation or it's a reversal. From where? From 9. In this case, what we found that the market that opened picked the high, and then from that high, we saw the market dropping all the way to the downside, matching the swing that fueled an upward movement right here, and it even surpassed it to the downside, which means this is a reversal to the downside. So a reversal to the downside means at the right time we want to sell. So that means if we were to combine the variation of the 15-day open candlestick with the direction of the market that we found right here, means we want to find the market opening at 15-day rise with an intention of dropping, because we've already found the direction of the market that we want to sell. So if the market opened, dropped, we were not going to fall for a buy, because we found the direction of the market right here that we want to sell. That is how the way, the direction of the market save you from the tricks that the market can try and play you with in that case. So therefore now you can use the H4 candlestick. So what exactly do you want to see on the H4 candlestick right here? We want to find out if what we found here on the 15-minute time frame doesn't match with what we found on the H4. So that means on the H4, we don't want to see candlesticks that will show signs of loss of momentum from the downside to the upside, and we don't want to see anything that serves as a reversal from the downside to the upside and all that. We don't want to see all of those things. I'm still going to explain that when we get to the real price chart in that case. And then after that, now we are going to talk about the impact of the midnight up to 9, which is the one that is so important. Right now, we found the direction of the market, and then we want the market to open, rise, and drop from there. The impact of the midnight to 9 will help us into understanding exactly if the market will be active at the right time or not, because you can find everything lining up, but when it is time for the market to move after you have jumped into a trade, we find out that the market doesn't move from there. The market doesn't have momentum. So how to see if the market will have momentum or not? Right here we have two places. We've got 9, so we've got midnight to 9, and then we've got the right time. If the market starts at the day with more volume, means at the right time right here the market is going to consolidate or is going to misbehave. But on this day, as we see, what it have is it starts at the day, it's a very, very low volume, which is something that is good. Or even if it may not be that low, something is moderate right there, it's fine. Therefore, that means at the right time, you're going to see the market being active, which is exactly why you saw the market being active right here, is because it started the day very, very, very nicely in that case. So this one is a vice versa. If the market started today, it's a high volume, means at the right time, it's either the market will misbehave or it will consolidate or being choppy. But if it started today, it's a low volume, means at the right time, you're going to see the market being clean. In terms of the movement, it will be decisive in terms of the movement. Now, entries are taken between 15-day and 16-day. Let's say the market opens and then it play right here. It doesn't rise in this case. It keep on doing this up until we are around 5. It rises with an intention of dropping to the downside. We were not going to fall for that because we said you don't take positions right after 1630. Positions are kept between 1530 and the 1630. In between, you don't take trades on the other side of the market. We don't do that, from them. I think now you now understand, do get the point of what we are looking for, how we are looking at it. Now let's move to the real price chart using the bar replay. Now we're here on the real price chart for the NAS 100 with a bar replay. Let's see. We are analyzing this day. We want to see how to approach this day right here. Let's play. Now we want to start by assessing the start of the day, midnight up to 9. So that's why we are going to mark 9. Okay, from midnight to 9. That's what we want to see first. Let's play. Right, now we're here. What we want to see right here, we want to see or assess if the market started the day at a high volume or at a low volume. As you can see right here, small type of candlestick, and the market is not moving decisively. It's simply moving in just one place right here, which is exactly what we want to see. So therefore, by looking at this, we can almost conclude and say at the right time the market is going to move, because it's going to be a vice versa, right there. Let's see. So now we are assessing from 9 to 15. Let's put this to 15. Let's play. Right, now we are here. In this case, what we have? We have the market that opened peak one direction to the upside. So this is a continuation. In this case, we don't have anything as a reversal, just like the other example that we did right here. It's only the market open peak one direction. In that case, if the market is giving us a continuation, it means at the right time, what we want to see the market open, drop 1530. Then after that, we want to continue to the same direction. That's what it means. Easy as that. It's a continuation from there. But before you can conclude with a continuation, you have to check what is called the ADR, the average daily range, that you saw me writing about right there, the ADR, which I didn't explain there. ADR will tell us if is this continuation still valid, or the market will simply consolidate or just reverse back down. If the market has reached an ADR, means you are going to see the market failing to continue to push. Instead, what you can see, it will consolidate or simply reverses. So the ADR of the NAS 100 around this day was around 1.92% up to 2%. That's where it was playing around in that case. So when you measure it, you have to check. So when you measure the ADR, you mark from the low to the high. So around this day, we said the ADR, it was playing around 1.9 to 2%. And this thing right here, it's 1.3%. The market had only covered 1.3%. So that means 1.9% is still too far from 1.3%, so there's still more gap. That means a continuation here is still valid. A continuation is still valid in this case. So therefore, we can conclude and say we want to see the market open, drop, and continue from here. Let's see. Okay, now this is 1530. Now when 1530 opens and then you see a shallow candlestick like this, as I mentioned earlier, that it won't always be a case of 1530 that will always take us into a trade. It won't always be like that. Sometimes we'll have to wait for other candlesticks to paint out before we can find a trade in the case, because 1530 failed to take us into a trade from there. So that means right here, since we have a shallow candlestick right here, we still want to see the market drop a bit before we can start to buy this instrument in that case. Alright, as you can see right here, this thing has dropped from there. Now when the market is still dropping right here, you can still find trade while the market is still dropping, or when the market is moving a bit up. It's just that this is a bar replay. I can't show you that. I can't show something like that. It's already happened. The market moves in sequence in that way, so I can't show you how to jump in while the market is still dropping or when the market is still moving. So instead, what we can just do, we can enter from the close of this candlestick, from the closure of this candlestick, and then take stop losses a few pips below, and then after that we are going to measure the first TP at 1:2 risk-reward ratio to be realistic, because that's exactly what you want in the market, 1:2 risk-reward ratio, and then you're going to be sorted. You don't want to be unrealistic, aiming for 1:5, all those high risk-reward ratio. From there, first TP should be 1:2 risk-reward ratio. Then after that, anything can happen. You can hold if you want to hold, but 1:2 risk-reward ratio should be your main first TP. Right, let's see. Alright, that's exactly what happened after you've jumped into this trade. The market becomes very, very simple when you approach it in this way. Very, very, very simple and straightforward. You don't complicate this thing or overcomplicate it. Simply just approach the market with what you've just studied here. Don't try to mix it up or do anything other than what we just spoke about right here.